So Kumar's question is, why would I buy an established property when there are stamp duty savings on house and land packages? So I guess this is the dream for investors, right? When you're an investor, you're thinking about how can I save on the costs of which I'm buying at the very beginning, right? So to give you an example, I can't remember which numbers I ran, which state I ran this number for here, but you buy a house and land package, and again, I've been pretty conservative here with some of the numbers, but maybe the total package is all in for 750, the land's 350, the build is 400. You put down your 20% deposit, which again, that's a lot of cash to be putting down as a deposit. Most people, if they're doing that, they're probably doing full equity on that as well. They might have taken equity out of their home to fund that, which I didn't factor this into the calculation, which would be interesting if I did. The loan, 600,000 at completion, and then you go on interest only during construction. We're at a 6.5% interest rate. We've rounded some estimates, and the build time we've factored in here about 58 weeks, which is in and around the mark. Now, 750 purchase price. Your stamp duty on an established property is 30 grand. Your stamp duty on this one's going to be 11,000, so you're saving 19 grand here at the beginning. So this is again making some wild assumptions that house and land package home is going to get just as good as growth with an established property, which it won't. Don't have time to get into that. But then you've got all these other hidden costs, right? So your land settles, you start paying interest or principal and interest on that one, and then you've got three, and it's normally principal and interest, I believe, on the land component, but we've only run interest on that. But that's 3 grand straight off the bat. Then 12 weeks later, the slab's down. You've got another interest component you need to start paying there. Then the brickwork gets complete. That's the next phase, another 4 grand of interest. The roof goes on, another 5 grand. Your lockup stage, another 5.8. The final fit out comes, you're at 4.8. So by the time we've kind of ran through all those numbers, at face value, you've saved 19 grand, but your interest only repayments and total construction costs is actually 25,000 over that kind of 10 to 12 month period. And that's also why you're getting no rental income from that property as well, right? So that's something else to factor in. Whilst you've saved money on the stamp duty, you've bought an asset which you basically lost that saving and gone over, and you've received no rental income. You've also still got some holding costs, so council rates. You're still going to be getting insurance. Absolutely, you'd be wanting to get insurance on the builder, which will be going on there. And that's assuming that there's no other delays, variations, inflation that happens along the way. So for me, don't get sucked in by saving at the beginning. There's normally, you've got to peel back the layers and dig a little bit deeper into that as well, because in general, when I've run the numbers, now probably more at the simplistic end, we run the numbers through there as well. Not a lot of savings to be had there, and you're normally going to be getting an asset that, from a capital growth perspective, is going to be quite poor. Where there has been a really huge investor trap in house and land packages over the last few years is that some investors who were built during COVID, again, they've gotten dumb luck. Building costs went up. They maybe had fixed costs, or maybe they got in early before the costs went up. They've done the house and land package build. Cost of build's gone up 50%. They think that they've found this pattern of building house and land packages because it made you profit in the first time, when history says, if you go back and look into the numbers, that you normally go at about 2 to 3% per annum capital growth. We've done a really long video on this one. I think Jacob did one several years ago where we looked at about 9,000 properties through Queensland. They ticked at about 2-3% per annum for about a 7-year period. So that's what you're going to expect in terms of growth. Don't put this one tiny little blip on the radar of a pandemic where cost of build went through the roof, thinking that you found a really repeatable and successful strategy, because decades of experience previously will say that's not the case. And typically what you will find is that when you build that house, even if it's on the outskirts of where there's established property, you're going to be normally overcapitalized. That $750,000 property in this example, if we were building it, let's just say in Ballarat, and the median house price is $550,000, $600,000, great, you've got the most expensive property in the area, and you're the furthest away from all the good infrastructure. So that's another thing to just keep in mind for that one there, Kuma.